All right, let's talk about something called the Goa-Dubai tax trap. It's a huge financial pitfall that catches thousands of remote workers in India every single year. So let's dive right in.
So, picture this. You are absolutely living the dream. Your laptop's open, you're working from a beautiful beach cafe in Goa, maybe a quiet cottage up in the mountains. You've got that perfect remote work life figured out.
And your company? Oh, they're thousands of miles away. Maybe they're in a skyscraper in Dubai, maybe somewhere in the US. And your salary? It hits your foreign bank account in a foreign currency every single month. Life is pretty good, right?
And because of all that, you're probably thinking, hey, the company is an Indian, the money never even touches an Indian bank, so I don't owe any Indian tax, right? Well, this is exactly where that dream can turn into a total financial nightmare, because the income tax department sees things very, very differently.
See, here's the thing you absolutely have to understand. Indian tax law doesn't really care where your boss is. It doesn't care what currency you're paid in. What it cares about is where you are physically sitting when you do the work. If you're working from Indian soil, that income is considered earned in India, period.
So why on earth does this happen? Well, it all boils down to one critical concept: your tax residential status. And trust me, it's a trap that is shockingly easy to fall into.
182 days. Memorize this number. This is the magic number you absolutely need to burn into your brain. If you spend 182 days or more physically inside India during a financial year, that's from April 1st to March 31st, everything changes. The moment you cross that 182-day line, you officially become a tax resident of India. And this isn't just some small detail. It's huge. It means your entire global income, every single dirham or dollar from that Dubai employer, is now on the table to be taxed by India.
Just look at the difference here. It's night and day. As a non-resident, you're only taxed on income that's connected to India. But the second you flip that switch and become a resident, boom, the Indian tax authorities can claim a piece of every single rupee you earn, no matter where in the world it comes from.
But wait, it actually gets worse. And here's the real kicker. This isn't just your problem. The way you're working could be creating a massive hidden risk for your foreign employer too.
It all comes down to this concept called permanent establishment, or PE for short. In simple terms, it means that if you're working from your home in India full-time, the tax authorities can basically decide that your home office is, for all intents and purposes, an unofficial branch of your foreign company. And if that happens, your employer is suddenly on the hook for Indian corporate taxes on any profits connected to the work you do. We're talking audits, back taxes with heavy interest, major legal headaches, the whole shebang. And yes, all of this can be triggered by just one remote employee, you. Okay, I know this all sounds pretty terrifying. You're looking at a huge personal tax bill, and your company is facing a massive corporate risk. It sounds like a mess. But what if I told you there was a much smarter way to structure this whole thing?
And that brings us to the solution. Let's call it the freelancer fix. It all comes down to making a strategic shift in your professional identity, moving from being an employee to operating as an independent professional or a consultant.
And the difference is just powerful. Look, in the employee model, 100% of your salary is taxed, and the PE risk for your company is sky high. But switch to the freelancer model, you can literally slash your taxable income in half, while dramatically lowering the risk for your client. It's a win-win.
So what's the secret weapon here? It's called Section 44 ADA of the Income Tax Act. It's a presumptive tax scheme. Now, that's just a fancy way of the government saying, look, we'll presume 50% of your income went towards business expenses. You don't need to show us receipts. You don't need to prove it. Just pay tax on the other 50%. It's incredible.
And you know, this scheme is specifically designed for professionals like you. If you're an IT, a technical consultant, an engineer, you're almost certainly covered. And with a high limit of 75 lakhs, as long as you're getting paid through the bank, this fix is genuinely accessible to a huge number of remote professionals.
Okay, so using 44 ADA is already a massive game changer. But we're not done yet. That's just the starting point. Let's look at how you can stack even more savings on top of that and what your next steps should be.
Let's actually put some real numbers to this. Say you're earning 20 lakh rupees a year. By simply changing your structure from an employee to a freelancer and using 44 ADA plus some other basic tax planning, you can save over 2 lakh rupees every single year.
So here's your playbook. Step 1, you structure yourself as a consultant and file your taxes using Form ITR-4 to claim that awesome 4480A benefit. Step 2, on top of that, you use the standard deductions, max out your Section 80C limit. And Step 3, add that extra 50,000 rupee deduction by investing in the national pension system.
And this is why this matters so much. Getting your structure right isn't just about being compliant and following the law. It's about being smart with your own money. It's the difference between paying tax on your full income and paying tax on less than half of it.
So look, you're out there building this amazing, modern, global career, all while enjoying the freedom of working from India. The only real question you have to ask yourself is this: is your tax strategy as modern and as smart as your career is?